All right, I think we can go ahead and get started now. So, hello and welcome everyone. I'm Jennifer Baylard, Director of Professional Development with the Rhode Island Association of Realtors. Thank you for joining us for our webinar today, the 2026 Economic Outlook and Real Estate Market Trends. Just a quick housekeeping item before we get started. You'll notice your microphones have been muted. If you do have any questions for our speaker today, please go ahead and enter them in the Q&A section that's located at the bottom of your screen, and we'll do our best to answer them as time allows after the presentation. And I actually see a question that came in already, and that is asking if this is going to be recorded. And yes, it will be recorded for viewing later. So thank you for sending in that question. All right, I am thrilled to introduce our speaker today, Nadia Evangelou, Senior Economist and Director of Real Estate Research at the National Association of Realtors. Her research focuses on the effect of economic, demographic, and industry conditions on the current state and outlook of the residential and commercial real estate markets. Nadia oversees the production of NAR's proprietary housing market data, including NAR's monthly existing and pending home sales indices, housing affordability, and quarterly local market reports. She also manages policy research, leading research projects on topics including how federal, state, and local policies impact the real estate market. Her research and insights have been featured by major media outlets. In 2022, Nadia was named one of the Housing Wire's 2022 Rising Stars. Nadia holds a master's degree in applied economics from Johns Hopkins University, as well as advanced degrees in international European economics and public administration. All right, Nadia, I know you have a lot to cover in a short amount of time, so I will turn it over to you.
Thank you, Jennifer. Thank you. So, good morning, everyone. So, it's such a pleasure to be here with all of you today. So, I wanted to start a little differently, not with the chart or like a forecast, but with something very human. So, we are at the time of the year when people reset. So, when they pause and say, "Okay, this year I'm going to do things differently." Actually, what we see is that about 1 in 3 adults make a New Year's resolution. So, and when researchers look at what those resolutions are about, more than 60% are tied to financing. So, saving more, for example, paying off debt, buying a home, downsizing, like moving closer to family, making a decision that feels more stable. And housing sits right in the middle of all of that. So, for most households, housing is the largest monthly expense, the largest like financial asset, and the decision that determines whether their financial goals feel realistic or overwhelming. So when people ask what's happening with the economy, what they're really asking is, can I afford my life? Can I move? Can I stay? Can I plan? So that's why housing feels so emotional right now, and why your role as realtors is so critical like, for them. So let's first step back and really ask, like, what changed in 2025? What stayed stubbornly the same as we ended the year? And what does this actually mean for the decisions that buyers and sellers are about to make in 2026? So I will start sharing my screen. Just bear with me. Let's start first with some reflections about the economy. So in 2025, the Federal Reserve cut interest rates 3 times. So when you look at the timing of these cuts, it was September, October, and December. So what you're seeing is not urgency. So the Fed was cautious. The Fed didn't rush, as we saw. They moved slowly. So the key question is if they will continue to cut rates like this year. And I think that, yes, they will do. We may have like about a couple of rate cuts later in the year. Why? Because as we will discuss a little like later, slower job creation will help them to bring like borrowing costs down. So this is a determining like factor that can help them to move like with lower interest rates. But let's go first to see now how mortgage rates are reacting like this time. And we get that what is happening right now, it's very encouraging. So mortgage rates are significantly lower than a year ago. And it seems that they're stabilizing. So by December, that we have the data end of December 2025, that the average 30-year fixed mortgage rate was about 6.2%, down from 6.7% a year earlier. The 10-year treasury also eased. So that may not sound dramatic at first, but when you translate that into a monthly payment or into how many households suddenly qualify again, it becomes very real and very fast. So this is why even a half-point decrease matters so much, like in housing. So in the meantime, what we also see that it's very interesting is that the spread between the 30-year fixed mortgage rate and the 10-year treasury fell to below 200 basis points for the first time since 2022. In fact, that's not very surprising. We actually expected mortgage rates to move closer to the 10-year treasury once the Federal Reserve stepped back from quantitative tightening. Why? Because what the spread is, the spread between the two, the 10-year treasury and the 30-year fixed mortgage rates, essentially the extra premium investors demand to hold mortgage-backed securities instead of treasuries. And when that premium narrows to around 2 percentage points and lower, it usually signals that the mortgage market is feeling less risky and more stable. So this kind of narrowing indicates that mortgage pricing is becoming now more normal. So this can help, of course, mortgage rates to move a bit lower, even without a big drop in the 10-year treasury. So it gives more room for the 30-year fixed mortgage rate to come down compared to the 10-year treasury yield, but it does not suggest a sharp decline. We don't expect any sharp decline in mortgage rates, but definitely it's helping mortgage rates. So rates are, what we see is that rates are reacting differently from how they responded in 2024 when the Fed cut the rates during that same period. So in 2024, if you remember, by December, they had increased that back to near 7%. Why this time is different from 2024? Because there is a different backdrop. So last year, in 2024, rate cuts happened while the economy was still running hot. In 2025, job growth is slower and unemployment is edging up. So the labor market has cooled enough that gives the Federal Reserve to have some more room to act with potential rate cuts. And of course, investors see that. They anticipate that the Federal Reserve will continue with further cuts this year as well. Not too many, but as I mentioned, about a couple of them. So, and actually our forecast is mortgage rates, and we'll discuss about that, to average about 6%. So this doesn't seem to be a big change from what we currently have, but have in mind that even small changes in mortgage rates have a significant impact on the borrowing cost. So for example, 1 point drop in mortgage rates can increase purchasing power by about 10%. So enough to bring millions of households back into the market, specifically when mortgage rates drop from 7% that we had, for example, during the summer, to 6% that we expect to have this year, to average at that level. What we see is that about 5.5 million more households, including about 1.6 million renters who are the potential first-time buyers, will once again afford to purchase the median price home. So that's very important to keep in mind. So let's move now and take a closer look at the job market. So the labor market remains healthy with adding jobs, but significantly less. So if you remember back in September, we had the big jobs revision that showed that the economy actually had about 900,000 fewer jobs over the past year than we thought. And that's a significant adjustment. But of course, revisions happen every year, so they're totally normal. But usually they're smaller. They're in the tens of thousands, not close to a million. We originally thought specifically that the economy added 1.8 million jobs from April 2024 to March 2025. Turns out that it was less than half of that. It was about like 850,000 like jobs. That's an average about like 75,000 jobs like a month, which is much slower pace than we believed. And the recent releases like confirm that indeed there is a slowdown in job creation. Should we be worried? What does this mean like for the economy and the housing market? So slower job growth means households may not have as much income growth to spend, and that can ripple into the broader economy. It also means the Fed has more reason to think about cutting interest rates, since a cooler like job market takes pressure off like inflation. However, I don't think that it will impact significantly the housing market like this year, at least like at the national level, this slowdown that we see. But let's now see how the labor market performs by state, and specifically in Rhode Island. So I want to spend a minute on this slide because, as you can see here on the second map, we see that Rhode Island had fewer jobs than a year ago. So here in this map, you are able to see how many jobs we have now compared to a year ago as of November. And what we see for Ireland is that we have fewer jobs, about 0.1% than a year ago. But let me give you some context on this. So if you look at Rhode Island's employment history over the past 4 decades, for example, one thing stands out very clearly. So this is the state that regularly cycles between modest growth and we have modest growth and mild contraction. So flat or slightly negative job growth is not unusual here. It's actually part of Rhode Island's long-term economic pattern. So if we go back to 1980s, for example, and early 90s, we see long stretches where year-over-year job growth was negative, sometimes deeply negative during recessions. So in the early, for example, 90s, Rhode Island experienced job losses of 5, 6, 7, or even 7% year-over-year. So that was a true labor market downturn. So compared to that, today's minus 0.1% is barely a ripple. Even in more recent history, the mid 2000s, the years leading to the great financial crisis, we see that Rhode Island frequently hover around zero growth, dipping slightly negative before the stronger recoveries. So that pattern repeats again and again in this data that we see. So now it's let's fast forward to the pandemic period, because this is important. In 2020, Rhode Island saw an unprecedented shock as every area in the country. So job losses exceeded 20% year over year at the worst point. And that was historic. That followed in 2021, 2022 was also historic, a very sharp rebound that we had during this time, with job growth running well above normal, and in some months over 15 or even 19% year over year. So we had strong job creation. So that wasn't, of course, we cannot have this growth to continue like that, but it was a recovery growth. So by 2023, 2024, that recovery naturally faded. So job growth slowed from 2 to 4% range, down toward 1%, and then below 1%. And now in late 2025, we're essentially at 0%. So when we see the minus 0.1%, what's really telling us is this. So Rhode Island has completed its post-pandemic recovery, has returned to its historical baseline. So this is not a labor market, I will say, rolling over. So compared to a year ago, yes, momentum has slowed down. Compared to pre-pandemic, employment levels are largely recovered. We have about 2.3% more than the jobs that we had in March of 2020. And finally, how Rhode Island compared to other states, we see especially fast growth Sunbelt markets, Rhode Island is less dynamic, but also think that it's like far less like volatile. So since it doesn't have like big changes like during the years. But I would like now to move to something else, like, but what about like inflation? So based on the latest figures, inflation fell again back to 2.7%. So it's still above the Federal Reserve's target, but it's still like below the 3%. And likely inflation will continue at this level or even lower. Why? As we can see here, shelter costs remain the main driver, running at about like 3.5%, still higher than overall inflation. So in fact, what we see is that housing continues to account for the majority of what's keeping like inflation above the Federal Reserve's like 2% target. The good news is that this increase is narrow, not broad-based. So most categories, energy, used cars, food at home, have leveled off or even like declined like slightly. So what's really keeping like inflation sticky is housing and services. So both of which move slowly and are heavily like influenced by rent trends. But here is a key nuance, I will say. So the official CPI shelter index lags very well behind what's actually happening like in the market. So we get from the private sector, we get from data from there that the rent growth is less than 1%. So, but we don't see that in the federal data yet. So while shelter accounts for about like 40% of the CPI, this can also mean that the shelter component will help with inflation to remain close to 3% and maybe like falling even further. So that's important for policy. The Federal Reserve knows this lag or that the discrepancy like exists, but of course they have to respond to the data that they have. So not the data that we expect. So even though market rents are softening, and they're like relatively flat, like the rent growth, the central bank will want more evidence like before cutting like rates again. And as they mentioned, they don't plan to do it like in the first like months of the year. Now let's step back. Now let's step back and look at the big picture, so the overall economy. So the U.S. economy continues to surprise to the upside. So in the second quarter of 2025, so GDP grew at an analyzed like 3.8%, stronger than last year, like 3.6% in the same quarter, and well above the 2.5% pace we saw like in 2023. So that means growth is not just holding up, it's accelerating even after 2 years of high interest rates. Economists spent much of 2024, as you know, like predicting a soft landing. So, and what we are actually seeing is a remarkably resilient expansion. What's driving it? So first of all, consumer spending remains the backbone. So even as inflation like edged up, households continue to spend on travel, dining, healthcare, and experiences. Retail sales and personal consumption are still like rising year over year, remarkable for this stage of the cycle. So from a Federal Reserve perspective, this is both good and complicated news, of course. So it confirms that the economy is strong enough to handle gradual easing, but also means that the central bank will remain cautious about cutting further, like given how much momentum like remains in the system. So despite all pressures, the U.S. economy like continue to grow, not explosively, not dramatically, but steadily. We have like a steady growth like in the economy. By now, I think we have a pretty good idea about the state of the economy. So let's take a look now to see how the housing market has responded to this economic development. So over the past few years, we have experienced one of the most unusual like house cycles in the modern history. So we went from record low mortgage rates to the fastest rate hikes like in decades. We saw a surge in demand during the pandemic, followed by years like of limited supply and double-digit price growth. And now we're in adjustment phase. So inventories are finally rising again. Prices have started to stabilize, relatively flat price appreciation. So it should be the moment when the housing market finally normalizes. So more homes should also mean like more sales, right? That's what a healthy market will typically do. But let's take a look here at this graph. So I included here how the inventory of existing homes like available for sale and the home sales activity have been trending since 1999. So what do we see? First of all, for the period 1999 until like 2005, so before the housing downturn, we see that these two factors were moving together. So something that we usually expect to happen in a healthy market. More homes available for sale make home sales to increase, since these more homes translate to more options for buyers. Then, you can see after 2013, with under construction, the inventory was declining, as you can see here, but home sales activity was strong. It was going like stronger and stronger. So this is when it started, this housing shortage that we are still experiencing. But one question could be like how home sales continue to increase back then. And the main reason is that due to strong affordability. So during 2009 and 2019, like before the pandemic, let's take until like 2019, affordability was very strong. So the typical family, to give you like more context, the typical family could afford to buy a home about 70% above the median home price, or otherwise, this also means that the typical family was earning about 70% more than the income needed for the median priced home. And again, so this housing cycle is not behaving what we see like currently normal either, for the opposite reasons as back in the history and back like that we see like between 2009 2019. So what we see currently now in the cycle that we are is that even with listings up, home sales remain flat. They are not, in other words, they're not rising the way that we expected in a normal, that we will expect in a normal market. And that's surprising, especially given how constrained supply has been like in the recent year. So this is something to have in mind. Like 2025, even though with better mortgage rates, we didn't see the activity that we expected. So again, the market is not reacting in a healthy like way, at least like not yet. We don't see it that. Then we get a different story when we take a look at the market by price segment. And that brings us to this slide. So while national sales growth barely nudged above zero, the luxury segment grew more than 16%, that we have like the latest figures. So home sales in the price range, specifically, as you can see here in the slide, price range $100,000 to $250,000 were relatively flat from a year ago, but home sales for over $1 million increased by 16%. Why? Because these higher income buyers are less affected by rising mortgage rates, because they often pay cash or need smaller loans. In addition, real estate like remains one of the most trusted like asset like classes for preserving wealth during volatility, and also have in mind that the post-pandemic reshuffling hasn't stopped. So affluent households are still relocating to optimize like lifestyle, think coastal like second homes, tax-friendly like states, vibrant like walkable urban neighborhoods. So while the broader market trades like water, the luxury segment is quietly thriving, driven by equity and long-term like vision, since but we actually also see in them consumer spending as well. So we see that the consumers in the higher income levels are driving like the economy and the economic like growth that we also see there. So the same we see in the housing market currently. Then when we look at home prices, we get that despite not more sales, prices continue to rise. So in fact, they're about 1% like higher than a year ago. Of course, this is not the appreciation that we have seen in the recent years, but it's a much like healthier level that helps like both buyers and sellers. Sellers get price appreciation, and buyers, it's not so unaffordable. It doesn't make affordability significantly weaker. So, and as you can see here in this slide, home prices are rising faster than nationwide in Rhode Island, 5.2% higher than a year ago, exceeding the $500,000 as of November 2025. Why? Because the inventory is very limited in the States. So as you know, Rhode Island already had structural supply constraints long before the pandemic, so limited land, zoning regulations, and the housing shortage continues in this area. So the months of supply specifically is just 2.3 months as of November, while 6 months of supply is what we want to have in a balanced market, 5 to 6 months. So this limited inventory continues to drive up prices significantly faster than the national level. But let's see now something very important. So in fact, despite higher home prices, affordability improved in 2025 across the country. So the share of income needed for the mortgage payment declined to about 24% and less than 24%, 23.7%. And in fact, that's the best level we have seen since the beginning of 2023. So why did this happen while prices increased? Remember that there are three factors that affect directly housing affordability. Yes, home prices increased, but mortgage rates eased, as we mentioned, like from about like 6.7 to 6.2, so around 50, 60 basis points. And then another important part of the puzzle is the income. So income has grown about 4% from a year ago, faster than than home prices and inflation. So lower rates and higher income offset higher prices, and housing is more affordable from a year ago. There is also an improvement in the area as well, but for example, in the Providence metro area, the payment to income ratio remains higher, above the 25% that we actually want to have for buyers to be not to overspend, not to be cost burden. And we see that in the Providence metro area is about close to 28%, which also reflects the affordability challenges that many people face in this area. So what does all this tell us about 2026? First of all, mortgage rates will ease further. So not very significantly, they will average around 6%. But even this increase, it's enough to bring like buyers back to the market. Then inventory is improving, but we are still missing many listings that are affordable for most of Americans. So more activity, more movement, more listings, and all this help with the housing market. And we expect home sales activity to increase about 14% in 2026 at the national level. Home prices will continue to rise nationally about like 4% this year. So I would say healthy price appreciation expected for 2026. However, this improvement won't be the same everywhere. In fact, we think that the 10 factors that you see here in this slide will shape the local housing markets in 2026. So first of all, we have millennials, because what we see is that markets with strong millennial demand have a natural built-in like momentum. Then we have income growth, because affordability isn't just about home prices, it's also about whether local earnings can support like home ownership. Then job growth also matters. People don't buy homes when they feel uncertain about their employment. So I would say that strong, diverse labor markets support more confident like buyers. Then migration also tells another story. So markets attracting new residents gain energy, demand, and long-term like footing. One of the most like powerful indicators is, as I mentioned, is how a market responds when rates fall from 7% to 6%. So in some areas, that just one point drop like unlocks tens of thousands of newly qualified like buyers. Then the next main factor in our forecast is how well listings match local income, something that finally began improving like in 2025, and we expect this to shape like the activity in 2026. Price cuts in the market is another indicator that we take a look and we monitor because it can help us understand whether sellers are meeting buyers where they are. Then another like factor is how mortgage payments compare to rents, because when those two align, renters start exploring like more about the possibility of buying. New construction trends, since this reflects building confidence and future inventory, and lastly, mortgage origination like trends, which is a clear sign that buyers aren't just like looking, they're actually like buying homes. So let's now see how Providence, specifically Providence metro area, compares with the national level in this slide. So Providence stands out nationally in several important ways. So first, rate sensitivity. So a drop from, from 7% to 6% allows more households in this metro area to afford a home than the national level. Specifically based on our analysis, about 31,000 like more households in the metro will be able to once again to afford to purchase the median priced home with this 1 point like rate drop. Of course, not all of them will buy a home, but usually about 10% of the qualified like households do it. So this also means that lower rates could bring about like 3,100 more home sales in the metro in the next 12 to 18 months. That's huge, especially because it means even small rate movements unlock like real demand here. Second, we have like mortgage growth. As you can see, like Providence saw 7.4% growth in new mortgages in 2024, compared with just like 2% nationally. This is about like 3.7 times like faster mortgage growth than the national level. And that tells us something important. So buyers aren't just talking about coming back. They're actually applying for loans. They're looking like in financing and moving forward faster like than in many other like markets. Third, we see pricing stability. So we get that only 42% of Providence like sales involved price cuts in 2025. Compared with about like 57% nationally. So that's also a sign of healthier market dynamics and a better alignment like between buyers and sellers. Finally, we also see that the change to in listing to income ratio, although as you know, like affordability is weaker like in the area, even though we are far from the balance, we had like stronger, we had better improvement than the national level, align more to the people's income, the listings to align better to people's income in 2025 compared to the national level. So that's very encouraging as well, but we want to see even like more homes to come at the price points that people can actually afford to buy in the Providence metro area. And finally, let's talk about investor activity in Rhode Island, because it really stands out. So when we talk about investor activity, I want to start by being very clear about what the data is and what it isn't. So this is not a story about investors suddenly showing up like overnight. So this is a gradual but meaningful like shift in who is like buying homes in Rhode Island. So, and in fact, I used a few different sources for identifying investors. So if we look at the most recent data, we see that 23% of residential sales in Rhode Island are going to companies, corporations, and LLCs. Nationally, the number is closer to 16%. So this data comes from the deeds records, and these are buyers, as I mentioned, corporations, companies, and LLCs. Sometimes LLCs can represent just smaller LLCs, like more individual like buyers over there. So we should also have to have that in mind, like key distinction in the data. However, what we see is that gap alone tells us that between 23% and 16% at the national level, that gap alone tells us that investors play a much bigger role here than they do at the national, the US market. Now let's layer in housing use, because this is important. What we see is that about 40% of housing units in Rhode Island are either rental properties or vacation homes, compared to 38% nationally. So that's another data that supports that we have more rental vacation homes in statewide than the national level. And specifically what we see in Washington County, for example, 17% of homes are vacation homes, compared to just 3% nationally. So that stands out over there with the substantial share of vacation homes in Washington County. So that tells us Rhode Island isn't just competing for year-round residents, it's also competing for seasonal and second home demand. But I also was able to find some other data that I would like to discuss, and it was stood out to me. And this is how the share, how investors have changed over time. So when we go back in 2019, based on the deeds records, again, we see that these corporations, companies, and LLC buyers accounted for about 11% of residential sales in Rhode Island. Actually, that was below the national share at the time. So fast forward to 2024, and that share has more than doubled to 23%, 22.5%. So over the same period, the national share barely moved, hovering in the mid-teens. So what explains that? So I would say, first of all, Rhode Island is a supply constrained market. So there simply aren't many homes available for sale, and new construction is limited. So investors tend to focus on markets where supply is tight, because that supports long-term value as well. So another reason can be Rhode Island has strong, steady rental demand. So the job base may not be booming, but it's stable, as I mentioned. So that stability makes the rental market attractive, and investors follow rental fundamentals, not just price appreciation. So another reason can be the vacation home dynamic, of course, matters. So coastal and amenity driven demand adds another layer of competition. So homes aren't just investment properties, they're lifestyle properties, as you know. So that attracts a different kind of buyer, often with more flexibility and capital. So what does this mean for the housing market? One effect is the competition, of course, especially at the lower and middle price points, as investors often target at these price points. And in fact, we see that competition, home prices, continue to increase very fast in the area. And also another a good effect is from that is the price stability. So investors are usually not for sellers. So if the market softens, they can rent the property instead of cutting the price. So that helps explain why Rhode Island has seen fewer price cuts and more resilient prices than the national average. And for realtors, that matters, of course. So it affects how you price homes, how you advise your buyers, and how you set expectations. In a market like this, understanding who the buyers are is just as important as understanding how many buyers there are out there. So finally, I included here in the slide one of our most impactful tools that we produce at NAR Research. It's our Metro Market reports. So these interactive reports include all that you need to know for your area, and it's everything here in just one place. You don't have to piece anything together to look for stats in different web pages, but we have done all the work for you here. So you first select your area. You include data. We include data for about 230 MTRAs, including Providence as well, and specifically areas that we receive data feeds. Then you select what data you want to get from the 8 categories that I included here. And then you're also able to retrieve a PDF of that report. So with that, I would like to end my presentation, and I'm very happy to get any questions that you have. Thank you.
Great. Thank you, Nadia. That was incredible information. Thank you so much for sharing that. We do have a couple questions from the attendees. The first one that comes in says, do you think the difference between nationwide and Rhode Island median cost has anything to do with quality of life issues?
Of course, we see that it's different. It's a big difference, about like $100, almost like $1,000. So, and compared to the income, unfortunately, it makes like tighter the affordability in Rhode Island. However, many people, they can afford that, and that's one of the reasons that we see that it's competitive there. Home prices continue to rise like very fast because there is demand, there is strong demand. And of course, limited inventory, it's one of the factors, as I explained, that makes like this price appreciation to be faster than the national level. But demand is there. This is what we see. And actually, the vacation homes like can also show why like this area is very desirable for many, because they want to move. You have like many vacation homes over there and great places to live. So I think that is one of the reasons that you continue like to have like so strong demand and very good price appreciation and demand.
Great, thank you. The next question, is there hard data that supports that job growth, especially in Rhode Island? And I kind of want to tack on to that too, Nadia, because earlier you talked about Rhode Island's job growth is slightly negative year over year. And so is that something that the housing market should be concerned about? So I'll make that a two-part question.
Sure. Yeah. So I will say I'm not concerned. So not in a meaningful like way. So a minus, as I explained, a minus 0.1% like reading tells us the labor market has paused, not weakened. Like Rhode Island has, as I mentioned, like long history of hovering around like the zero growth, like outside of recovery like periods. So compared to pre-pandemic, employment is largely recovered, and we're not seeing widespread like layoffs or like distress. So that kind of stability tends to support housing prices rather than pressure them. So this number reflects normalization, and I don't think that I expect any downturn or any big concern for the housing market due to employment in your area. So in a nutshell.
Great. Do you believe that Rhode Island has attracted a disproportionate percentage of institutional buyers?
As I mentioned, I have the figures. Sometimes we need to identify, because LLCs is a very big part of the purchases. So what we need to identify if we include them in the institutional buyers or not. So however, with the hard data that we have, the deeds records data, we are not able to identify the big LLCs. Unfortunately, we are not able yet, but we are trying to find a way to identify specifically the big LLCs. But what we see usually, for example, at the national level, only corporations and companies are about like 3.5%. So, and from 16%, it drops, like that share drops to 3.5%. However, what it's interesting to see, I think, in Rhode Island is how like going from a lower share going to a higher share like in 2024. So we're having like 11%, now it's like 23. So you see like there are many, the investment like activity is growing in your area. However, like in the national level, it's still relatively like flat, close to 15, 16% or like 70% that it was like during like when we had like the low mortgage rates. But in your area continues to go up, and that shows that it's attracting like many investors.
I think we've got time for these last two questions here. How do we slow down the corporations and LLCs from buying up Rhode Island inventory?
That's a very good question. I'm like, we support. I'm like, the administration came out like yesterday with banning like these big investors. As an AR, we support that. We give like incentives to release some of these markets, because what is concerning for many people, like for the markets, is that usually these big corporations are target on homes that they're like at the low and medium price range. So this also means that doesn't but they get some of the homes that are affordable for first-time buyers. So incentives to them, like to sell, that will be something to consider, and we have more to see, I think, in the next days on this topic.
Right. All right, and last question. If capital gains tax would go away, even for a time, perhaps investors would consider selling, making more inventory available. What do you think about that?
Yes, that's correct. And this is something that NAR advocates as well. We want to have at least or the cap to raise it from the 500 to 1 million. So just to release some of this, because we have many baby boomers that they are sitting on this huge home equity, and unfortunately they don't want to sell because they don't want to pay these taxes. So these can release some of the existing inventory and help with our housing shortage. Because have in mind that sometimes we are thinking about the housing shortage about new construction, and that's true. It's like how you can add more inventory out there, but almost 85% of the home sales comes from existing homes. So you also have to find a policy that can help existing homeowners to sell their homes and release these homes for other people to buy.
Great. Well, thank you, Nadia. That is all the time we have for today. So thank you. We really appreciate your time and for sharing your insights today.
Thank you, Jennifer. Thank you. Bye-bye.
And to everyone on the webinar, thank you for joining us. We hope you enjoyed this presentation. Thank you again, and we look forward to seeing you next time.